think the main trend that's occurring at the moment is we're seeing a pickup in global growth. We're seeing U.S. economic indicators look a lot better. The Chinese economy appears to have bottomed and is starting to see a gradual recovery. And at the same time, we're seeing still very low interest rates by the major developed economy central banks. And we expect that that will continue through the course of the year. That is supportive of risk assets and commodities in particular. The issues, of course, are that we have potential debt risks in the United States with the debt ceiling issue coming through very soon. And on top of that, we also have the potential for sovereign risks to come back in Europe. So that's the framework we're looking at as we enter 2013. On this basis, we probably at the moment be more focused on the higher beta cyclical commodities. So that would include copper, platinum, palladium, potentially oil, though we think that will probably range trade. But we also recognize that there's these key risks in the market, as I highlighted earlier. And we think you need to hedge against those risks. And gold is probably one of the very best hedges against a worst case scenario on the US debt ceiling issue, and probably one of the best hedges for European sovereign risk. So I think that investors will also want to be long gold. Now, admittedly, real interest rate expectations may rise, which could be a headwind for gold, but on the other hand, real rates should remain low. Central bank buying remains very strong, as does Chinese buying. So gold, cyclical commodities, and potentially oil as a hedge against Middle East risk. Okay, well, the recent trend really was in 2012, we saw around $30 billion in assets go into commodity ETPs, bringing commodity ETP assets to an all-time year-end high of $200 billion. So significant demand. Most of that focus was on gold. Again, I think investors still remain structurally concerned about rising debt levels in the West, particularly the US and in Europe, and that's not going to go away anytime soon. So I suspect that demand will remain in place. Maybe it will be slower than it was in 2012, but I think it will be strong. The other area where we have seen more recently strong interest has been in the broad commodity trackers. For example, the ETFS All Commodities Tracker, which tracks the Dow Jones UBS Index, has been seeing quite strong inflows since the end of last year, I think as a play on a pickup in global growth. And lastly, we've been seeing very strong inflows into our platinum, palladium, and also into our copper ETPs. Again, I think investors are beginning to position for the possibility of a more sustained recovery in the US and in China in the first part of this year.